A shocking crisis is unfolding across Germany, one that is soon to hit America. What's driving this chaos? Stay tuned. Now, let's pick today's story up with the headline because it's worse than the 2008 financial crisis as Germany becomes a nation of bankruptcy with no end in sight. And this is something we've been warning about because when economies slow down and demand goes down, what happens? You find out that there's too much debt and not enough revenue to support businesses and households. Next thing you know, delinquencies start to go up and then bankruptcies hit. And after that, you're in an all-out financial crisis. Now Germany headed into one far worse than the last. Allianz Trade forecasts an overall increase of 11% in corporate insolvencies in Germany this year, reaching approximately 24,400 cases. A further 3% rise to over 25,000 is anticipated for 2026. And these insolvencies put an estimated 210,000 jobs at risk across Germany. And that's just Germany alone because, of course, we know all of these businesses do business with other companies. And next thing you know, as their demand goes away, it's going to reverberate all across the supply chains. It's not just going to affect German workers, it's going to affect workers all over the Eurozone and the world. And this is a dangerous sign because we've talked about how Germany is likely to be the epicenter of the next crisis, particularly due to the slowdown in manufacturing and their over-reliance on exports. Now we're finding out that all of those months of contraction in the manufacturing sector are leading to a dangerous sign, that is insolvencies, and it only gets worse from here. Let's talk about how it's all about profits, and when companies see their profit margins go down, when they see demand go down, what it leads to is a rise in delinquencies. Let's take a look at some U.S. data for comparison here as we look at corporate profits after tax in blue against the delinquency rate in red, that on all business loans at commercial banks. And you can see going back to the late 1980s, corporate profits decelerated. They entered a contraction. The delinquency rate rose. We can see around 1998, the same thing happened. Profits contracted. Next thing you know, companies couldn't pay their bills. The delinquency rate rose right into the dot-com bubble. Saw the same thing going into the financial crisis, and then we saw pockets of it around 2015 and then 2019, and now we're seeing it again. And the shocking thing here is we've seen profits go up, but a lot of companies are still getting squeezed at the margin. One thing we do know is profits are likely to go down due to the trade war. And keep in mind, what was the effect of this? Consumers said, look, we can't afford higher prices. We want everyone else to absorb this. What that means for corporate profits, likely to head negative. And for a lot of companies, that means the delinquency rate is going to rise, and you're going to see insolvencies increase at a rapid rate. The risk is what's happening in Germany with these insolvencies is quickly going to spread all across the world. Given the bleak economic outlook both in Germany and global trade and the many uncertainties caused by the tariff storm, we expect many major insolvencies and thus significant losses to continue into 2025. And they added that these large-scale insolvencies will likely have a ripple effect on supplier companies, potentially creating, quote, particularly large holes in their coffers and impacting supply chains. Because keep in mind, if a small business goes out, well, what it means is not much to, of course, all the surrounding businesses. But when you have a large employer go under, well, that affects, of course, mid-sized employers and small-sized companies as well. And next thing you know, you see layoffs all across the chain. And this is a major problem because, again, Germany's economy is heavily dependent on exports. And due to the trade war, we know they're plunging. This is a sign, and an early sign, that things are about to get a lot worse and could be far worse than the last financial crisis. In the past few weeks, the economic situation has deteriorated dramatically. The facts are undeniable. Germany is in a serious economic crisis. You can see it now being declared officially. The comparison with other countries shows that this crisis is primarily homemade. Many people saying it has everything to do with German politics, but when you start factoring in the trade war and the slowing global economy since the pandemic, it's not just an issue at home. This is something we're going to see all across the globe because, again, you start to look at the trade war and we see the impact it's having on companies' bottom lines. At some point, there's going to be companies, just like what we're seeing in Germany. It's not going to be just a political issue. It's going to drive them into delinquency. Again, eventually then into insolvency unless things turn around. But I want you to see why they're unlikely to turn around and why the issues that are plaguing Germany are going to spread all across the world, including here right at home. Let's take a look at corporate profits, still in blue, now overlaid against imports of goods and services, that in red, both on a year-over-year rate of change. And you can see the strong relationship between the two. And what this means is global trade drives global profits. What we can expect right now is imports of goods and services are starting to plunge. This hasn't shown up in the official data yet, but what this tells us is that corporate profits are going to come plunging down. That means companies that are already on the margin financially are not going to have the revenue to pay on their debt. They're going to have to make some major changes. The problem is, without enough cash flow, what you're going to find out is the delinquency rate is going to rise and rapidly. And next thing you know, we're going to see large-scale insolvencies unless something changes and fast. But something that should be changing, that is the direction of your trading account. I just pulled the latest data on our two trading reports as of the close of business yesterday. Our CTA Timer Pro report that looks at machine positioning to generate trades currently has 4 open trades. All of them are up, and we just put 4 new trades on today. And yeah, you can jump in on those. Grab the links in the description below. Use the coupon code for your free 30-day trial. For our momentum traders, we have 7 open trades. 6 of them are up and an 86% win rate. And we've got a major announcement coming soon for our subscribers. It's going to blow you away with what we're building right now. But let's talk about what's going on in Germany. Because when profits go down, when imports go down, demand goes down. Well, there's something else that goes down, and that's the demand for labor. Ford Germany plans to cut 4,000 jobs as Berlin's economic disaster continues to unfold. Remember, this is just one of many companies. The entire automotive industry is in crisis all over the world. In Europe, and especially Germany, this transition to the electromobility is hitting us very, very hard. And this is the problem, because we're starting to hear companies say, look, this is a political issue. We were forced down this path. But again, you take into perspective the slowing global economy and the trade war. And what we're starting to hear from companies is, look, we have to generate a profit somehow. We have to stay in business, because if we don't, this whole thing is going to go away. Ford Germany saying, look, we've got to lay people off. We have absolutely no choice. The problem is they're not the only ones. As we can see, 210,000 jobs projected in Germany alone, and that could be devastating for their economy, plunging right into a financial crisis and driving the Eurozone down and the rest of the world right alongside. Let's take a look at corporate profits after tax, still in blue, and now we're going to overlay the unemployment rate in red. And what do we see? When profits go down and they contract, next thing you know, employers start to defend their profit margin. They have no choice but to lay people off as demand goes down. And usually when that happens, you go right into a recession. You see it happen in 91. You see it happen in the dot-com bubble, the global financial crisis, and now we're facing the same thing happening again. And I believe this is largely due to the trade war, but I want to know from you, is Germany's problems due to political issues? Is it due to the trade war? Or is it due to the slowdown of the global economy since the pandemic? Or perhaps all of the above? Weigh in the comments below. I'd like to know what you think, because again, when we face the reality that a lot of companies are taking the hit at the margin, there's only one thing they're going to have to do to stay in business when their profit margin goes negative, and that's lay people off. The inevitable is coming. And that's why I don't think America is immune to what's happening in Germany. And let's take a look at their factory orders, because they rose even after the U.S. tariff announcement. But there's a shocking news behind this of what the political elites think is driving this sudden increase in demand. Now, we already know what it is. It's front-running the tariffs. But wait till you see what they had to say. Front-loading demand probably played a role in Germany's robust first quarter performance, as Germany's manufacturing sector is heavily exposed to the trade tensions because of its reliance on exports. The economy is expected to stagnate this year. I think that's an optimistic perspective, following 2 straight years of contraction. But a planned spending boost by the new government should usher in a quicker expansion in 2026. So I love the idea here that they believe that government spending is going to save the day. This is the same thing China thought, and yet it didn't work there. Of course, we know the impact. When governments take on more and more debt, it is a drag on economic growth. That's why what we're finding out right now is a lot of the spending by governments isn't working. We forgot how to grow an economy. You're seeing it happen in real time. But look what the experts, look what these political elites had to say. It's shocking. The trend in orders is now pointing upwards. The German economy is benefiting from the ECB rate cuts, even if Trump's tariff increases are dampening the upward trend. So what is clearly a sign of front-running tariffs, I love it. They say, look, this has everything to do with rate cuts. Of course, we know that rate cuts do not have that kind of power on the economy, but anytime they can tie a rate cut to some form of growth, we'll wait till the months to come when we see, of course, factory orders in Germany continue their downward trend. This one-off month means nothing. Are they going to celebrate rate cuts? Well, probably not. Here we see at home, U.S. business optimism now slumps in a clear pivot from Trump election. Now let's go back to what happened after the election, and what did we see? Business optimism surged, and we said, look, this isn't going to last. And one of the reasons is because as soon as the trade war actually started, what happened is business optimism plunged, and good reason. What happened? Imports plunged. And what a lot of people don't realize, particularly on small business owners, is one, if you can't get inventory, you can't sell it. But the other side is we all benefit from global trade. Now, a lot of small business owners who have been hurting at the margin for over 3 years are finding themselves in a dangerous situation. We're seeing a lot of revised expectations, delayed hiring and investment, pared back expansion plans, lowered key performance indicators. The data shows a clear pivot from optimism to caution, and keep in mind, when a small business owner gets cautious, well, it means they're not hiring and they're not giving out big pay raises. Businesses are bracing for volatility, and the uncertainty around tariffs is amplifying that shift. Again, the challenge for a lot of small businesses, they don't have massive lines of credit. They don't have huge cash piles. They have a limited amount of resources to weather storms, and this is why you're seeing confidence for small business owners outright plunge. The report found that 1 in 5 business executives believes the U.S. is already in a recession, while another 34% say expect one by the end of the year. Of those expecting a recession this year or next, 75% predict it will be moderate to severe. I want to know from you, are we in a recession? And if we are, is it going to be moderate, severe, light? And if not, do you think we're going to be in one? And how bad do you think it's going to be? Weigh in the comments below. I'd love to hear from you, because what we're seeing in Germany with just the beginning signs of job losses, well, we're starting to see that here at home. As U.S. initial jobless claims rise to the highest level since October. Now keep in mind, they're still fairly low from a historical basis, but it's not how low they are, it's the trend, and the trend is moving higher as we see initial claims increase by 8,000 to 247,000 in the week ending May 31st. And one of the things that we have cited as a risk to the U.S. economy is that where continued claims go, and if they do not come down, initial claims will follow. And you can see continued claims in blue going back to, of course, the 2000s. What do you see? They're headed higher as we go into the dot-com bubble, and it lifts initial claims up. You see it happen during the financial crisis, and something that a lot of experts have said is, hey, initial claims are low. That means the economy is strong. And we've been warning, if continued claims don't come down, what you're going to see is initial claims go higher. We're now starting to see that because continuing claims are proxy for the number of people receiving benefits fell slightly to 1.9 million of the previous week. They remain elevated compared to last year, a sign that it's taking longer for out-of-work people to find a job. And that is the problem here. That is the risk to the economy, is the longer the people are on unemployment, they lose, of course, their optimism about getting another job. And the longer they're on that, their spending power continues to decrease. And next thing you know, it backfeeds across the economy. You start to see other people get their hours cut, a few other people get their job lost. And next thing you know, it starts to spiral out of control. And at that point, you see initial claims start to surge higher. For the U.S., this could be an early indication of what's to come. U.S.-based employers announced about 93,800 job cuts in May, down from April, but still elevated compared with last year's average. So what we're hearing from the Federal Reserve is the U.S. labor market is strong and robust. What we're hearing from U.S. employers is, look, we have to get rid of people here. We're concerned about the economy. And again, this is large employers. What we're going to face from small employers could be outright insolvency. The largest number of planned staffing reduction were in the services and retail sector. Now remember, we said that would happen as well. As soon as demand goes away, what happens in the services sector and in retail? They cut hours. It's the first thing they do. And if you don't have foot traffic in your store, you start cutting jobs. And you do that because you want to keep your high value employees. You want to be able to give them a raise and give them the hours that they need so they won't leave. Everybody else, you sacrifice And that is the issue here. We're finally starting to see the slowdown in consumer demand is starting to hit the labor market. Tariffs, funding cuts, consumer spending, and I think that's the big one, and overall economic pessimism are putting intense pressure on companies' workforce. The bottom line is it doesn't matter about funding cuts, nor does it matter about tariffs. If consumers continue to borrow and spend, and that's the beautiful thing of how a debt-based, consumption-based economy works. If people borrow and spend, nothing else matters. What we're seeing is consumers pull back, and we've seen that very clearly in the data because what they're telling us, they're worried about their finances, they're worried about their job, they're worried about their outlook for their finances. When that happens, we said this was coming. They cut spending. We're seeing it now on the retail side. It's very clear. Companies are spending less, slowing hiring. It means they're still hiring, but not that much, and sending out layoff notice to the excess employees they don't need. Again, these are all leading indicators that the U.S. economy is going in the wrong direction and following the path of Germany, who's saying we're in a crisis and it's going to get even worse. And this is why the markets rallied this day on the news that Trump and Xi spoke by phone as trade and tech disputes strained ties. The bottom line is what we're seeing is this crash in imports. We said it was going to have an impact on economies all over the world. We're seeing it in Germany. We're starting to see it here in the U.S. And unless this trade war ends soon, this is going to spiral out of control. The problem is it's not likely to. History suggests any final deal could be a long time coming. In 2018, during Trump's first term as president, the two sides agreed to put their dispute, quote, on hold after a round of negotiations, but the U.S. soon backed away from the deal, leading to more than 18 months of further tariffs and talks before the signing of Phase 1 deal in January 2020. My feeling is, my friends, if this went on 18 months, we're going to be in an all-out financial crisis. Germany now saying that we're finding out that bankruptcies are spiraling out of control and unlikely to stop as they face a financial crisis. So too will the rest of the world. But just because the global economy could come plunging down doesn't mean your trading account has to go with it. We have two great reports. Now, one of them is our CTA Timer Pro report that looks at machine positioning, and what we do is trying to position our subscribers ahead of a major wave of machine buying. And again, we publish this report every day, including all the notes on the trades that it recommends. Now, if you like to trade those momentum signals like the RSI and the MACD, well, our Momentum Timer Pro report, that's the one for you. And again, we provide notes on all the trades that we think are the ones you should take. But the edge we give on our momentum report is that we look at the trend. We pair that with the technical indicators, and that is a huge difference maker. And why we're putting up such big numbers for our computer model trading, well, we look at a historical overlay, and our big advantage is because we look at when machines are positioned offsides based on the historical trend. And again, that gives us the edge. Now, no matter which report you want to trade, you get the report, you get all the signals, you get my opinion on the best trades, you get risk control levels, and yes, we update them along the way. You get a full tracking of all of our open trades and returns, a weekly update, and here's the best part, you get a 30-day free trial, and we do that because we're so confident that you can make money trading our reports. We want your first 30 days to be on me. How do you do that? Grab the links in the description below, use a coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.